Hi, everybody. Welcome to another episode of the Financial Symmetry Show. Uh, my name is Christian Polanco, and I'm a financial advisor and partner here at Financial Symmetry.
And my name is Jade Brookerson, and I'm a portfolio manager here at Financial Symmetry.
And so today we are here to talk about what we wish we could have told our younger selves to be more financially successful today. You may have seen a blog post we posted recently titled, What I Wish I Knew About Money as a Teen. That's what we're going to talk about today. We want to take some time to address the fact that not many of us growing up, we didn't really get a lot of financial education in high school and middle school, and maybe sometimes we got to learn things the hard way. So we want to take the next few episodes in this series to discuss what are the best things that you should be doing today as a teenager to set yourself up for financial success.
Yeah, exactly.
Jade.
Thank you so much, Kristen. That's a great way to introduce us here. So I really just wanted to focus in this podcast with your experience with clients because you come across these questions every day, whether it's budgeting, debt management, emergency savings. And so I think we can really just build off of the experience that you've had here at Financial Symmetry.
Sure.
But before we dive into what you've seen with clients, I kind of just wanted to know at what age were you introduced to personal finance and how exactly did that introduction go?
I mean, the earliest piece of advice I think I ever got was from my fourth grade teacher. And she said, pay yourself first. And I was kind of looking at her like, what do you mean? Like, my mom always pays the bills first and then and then she pays me. No. And she just, every time you get paid, take a little bit of whatever you earn and just put 10% of it away in a savings account. And just always get into a habit of doing that. So you're always taking care of yourself, looking out for yourself. But outside of that, outside of fourth grade, I mean, I don't really think I got any personal finance education until, I got my first credit card in high school. And by then I thought I knew how credit cards worked. And I was like, yeah, you use it. And as long as you make the minimum payment, everything's good. No worries. But that's only half the story when it comes to credit cards. So I would say that, high school really was where I started to learn a little bit more about money before I knew I was even interested in working in the financial field. And I was just kind of figuring it out as I went, just kind of making mistakes and then being like, wait, why did this happen? And so today's about doing the opposite of that. We want to prevent you guys from making the mistakes and just making the best decision ahead of time.
I will say fourth grade is a pretty good early introduction.
Yeah. Shout out to Miss Johnson.
Yeah, go Miss Johnson, because I personally wasn't introduced into personal finances until I think it was like 18 or 19. That point was just luck with stumbling over a YouTube video and getting into it that way. But the terrible thing I feel like is that a lot of people don't get introduced until later on in life just because it's not part of our education, And so hopefully that's why we're here to talk about it with you and answer some of those questions there. So looking back, were there any simple mistakes that you made early on, like when you first opened up your credit card or outside of that you wish you knew about before?
I don't think I took my fourth grade teacher's advice very well. When I got that first paycheck, I got my first job at McDonald's, and you get a $300 paycheck when you're 15. That feels like a lot of money. And I think it just immediately went, out of my wallet to just buying things, right? Shoes, clothes, going out to eat, whatever. And so I wish I actually did save some money, like just $20 every time I got paid. Would have been nice. And maybe it would have set me up to buy my first car like earlier and, have a first car going into college. That would have been pretty cool. With credit cards, yes. So my understanding, I thought as long as you made a minimum payment, you wouldn't have to pay anything additional. But turns out making the minimum payment just makes it, just doesn't get you into trouble with, the creditors. They're not going to come after you saying, hey, like you owe us money. But outside of that, you're actually paying more back in interest. Nobody really explained the whole interest thing to me. So that was one key area. I'd say I wish I had more guidance on as well. And then investing, I think, I didn't really understand how to invest, why it was important to do it early, what the heck is a Roth IRA, what's a 401k, things like that.
Yeah, to build off of that first idea with McDonald's, what do you say to the person that's in that position now and is like, what is $20 going to do for me?
Oh, true. Right. Because I'm sure $20 back then felt like a lot, but
yeah,
probably not so much now. I think it's less about the amount early on, especially. It's more about building the habits. So if let's say, you have your first job, or maybe you have an allowance or something like that, getting into the habit of just saving, whether it's $20 or it's $5, 5%, 10%, whatever it is, it's just good to develop the habit. So $20 today, saving $20 every month today is going to equate to saving, $500, $1,000 every month when you're earning more money, right? And the more you get into the habit of it, the easier it's going to be to do as you start to earn more money. And, we're all going to be great, very successful in the future. So yeah, it's just about making it easier on yourself. Cause I think it's sometimes it's hard to save money when, there's that big shiny thing that you want, whether it's like the new pair of shoes, or you want to go on that trip to Italy, or your friends want you to go on go do stuff with them. I think being disciplined early on definitely pays off.
Yeah, no, I agree. Because I think that what people don't think about is how hard it is to start saving if you don't do it until you're 40 or 50. Because by that point, you have 40 years of this habit of spending everything that you have. So even though you may think now $20 isn't a lot of money, it is just that habit of being like, okay, I'm putting something away, so that way it's not hard for me later to start thinking about putting something away to save and invest. And also there's the fact of, compound interest and stuff like that, where you just allow it to build, and even small dollar amounts can make a really big difference over time. I also just want to know, as an advisor, obviously you see a lot. So I wanted to see a little bit about what you think should be known about an emergency fund that maybe clients come in and they don't realize right off of the bat.
Depending on your stage of life, the emergency fund is going to likely be structured differently. I think, what I would want to tell my younger self as a teenager is that the emergency fund is for unplanned expenses. So if it's something that is going to happen or likely to happen that year, you want to just go ahead and include that in your budget, meaning you just want that to be part of your regular spending. The emergency fund is going to be for just anything that happens that you're like, oh my gosh, like I'm in a tough situation where, I got a flat tire, things that are really out of your control. I dropped my phone, the screen cracked, got to replace it. So it's going to be for the curveballs that life throws at you. It's okay if you don't know how much you should keep in an emergency fund. Sometimes life will happen, and you'll know, like, okay, I need to have $500 in my emergency fund because that's how much it costs to replace my phone. Like when I dropped it in, a glass of water. It could sometimes make sense for your emergency fund to just be an overall part of your investment strategy, right? Like maybe you're keeping some cash at the bank for a rainy day, but maybe the other part of that emergency fund is being invested. Maybe it's invested in the stock market. Maybe some of it's invested in what we call fixed income. But I think that's a conversation for the future. Cross that bridge when we get there. But I think just starting off, you really want to focus on just having a nice, healthy amount of savings for the unexpected.
In terms of having a sufficient emergency fund, is that an amount that's set across the board, same for every person, or how do you gauge if your savings amount is specific and correct to your situation?
It's not going to be the same for everybody. It's going to be different for you based on your situation, because we all spend different amounts of money, right? We all have different expenses and things. But in general, start off, I would say you want to have at least 1 month of your must pay expenses. And what I mean by that is, what are the things that you spend money on that you absolutely need to survive? So that's going to be, food, shelter, and like must pay bills. So if you're renting, you want to have, 1 month of rent saved at the bank. I have some money for what you average in groceries every week. If you have loans or bills or anything like that you have to pay to keep the lights on, those are the numbers that you want to start adding up. Now, for, if I'm telling this to my 15-year-old self, he's going to be like, what? Like, I don't pay rent. I don't have bills. Like, I'm just hanging out right now. I think a really simple target to shoot for is $500. Like, just have that be your long-term target and start shooting for $100 as your short-term target. I think sometimes it could be intimidating to say, oh, you need to have $3,000 saved up or you're not going to be ready. Again, it's about the habit and not the amount when you're starting off. So start with, hey, I want to have $100 saved up in the next few months for just something unexpected. And then when you reach that goal, all right, let's shoot for 500, right? And as you're saving, as life is happening, when an emergency comes up, you start to get a feel for, okay, should I save more? Should I put more into this account? Or, am I at a good spot where I can replenish my emergency fund as things happen?
So it sounds like when you're considering building an emergency fund, a large portion of where that value is coming from is your budget, your income, your expenses. So for somebody who doesn't have a budget set up yet, how do they even start with going about tracking that? Is it best to do it in an Excel spreadsheet, an app? Like, what do you see with the clients that you work with that is the thing that they're going to stick to the most and that is the most accurate for them?
If you are someone that really likes to stay on top of the details and you like spreadsheets and you want to know exactly where every penny is going, an Excel spreadsheet can be a really good tool for that, right? Because you can customize it, you can be as detailed as you want. And there are also, there's a lot of good budgeting apps out there that allow you to really get into the nitty gritty of where all your dollars are going. And so if you come to mind as YNAB, which stands for You Need a Budget, that one I think is known for allowing you to be very detailed with tracking your spending. The other side of that, and this is for me, I kind of have shifted to this mindset. I used to be very like, I want to know where all the dollars are going, but sometimes to me that felt exhausting after a while. It's like, I don't care that I'm spending $15 or $20 on Taco Bell every week, right? Or not every week, every month. That doesn't really add value to, it just has no meaning to me to know that. So instead, if you flip it the other way, maybe think about it like, well, how much do I need to save to make sure my emergency fund is, where it needs to be? How much do I need to save to make sure that I can save for this new car I want to buy? Or how much do I need to save to make sure I can pay for school? Whatever those short-term goals may be, right? What do you need to be putting away for those things? And then also the long-term goals. If you are fortunate to have access to like a retirement plan with your first job, are you putting enough in there to get the employer match? Great. So really, in short, is the other side of it is have an understanding of why money is important to you and what are the things you want to spend money on, what are the things you really value spending on and saving for. And once you hit those targets, the rest of that money can go to whatever you want it to go to. It doesn't matter. You're taking care of your future self by taking care of your priorities first, and then the rest you can just do whatever you want.
I think that's something that's really important for people to understand too, is that a budget doesn't need to be restrictive.
Yes.
I think a majority of people probably think I have to have a budget and it means that I have to stick to exactly $200 of fun money, nothing over, and there's no flexibility whatsoever. But like you said, at the end of the day, the budget really is just about, one, figuring out where you are, using it as a roadmap for where you want to get to, and making sure that you are on track to your goals. But the nitty gritty in between that, of tracking every cent, it doesn't need to get that complicated or that overwhelming.
So a very simple framework to help you start budgeting, if you still feel like I just have no idea how to do this, or I don't really know if I want to do this, is to try something called the 50-30-20 rule. And so basically, in short, what that is whenever you receive, whenever you get paid, take 50% of your pay and put that towards needs. So rent, clothes, food, shelter, whatever that may be. I even consider, for me personally, like my Netflix subscription, I kind of consider it a need because it is something that helps me unwind after a long day of work, right? So it's good for my mental health. So I consider that high priority. Then 30% is going to be for whatever you want to spend it on, anything you want, for all the wants. And then finally, 20% of that is going to go towards savings. So that's the emergency fund. That's going to be saving for any expenses you have coming up, like large expenses. I always go back to buying a car because I feel like that's just the first thing that when I was a teenager, that was the first thing I had my eyes on. I was like, I want a car. Because I don't know, in a way that kind of gives you some freedom. You can go out and you do more things. That 20%, like I said, is going to be for savings. Now, let's say you're making $500 a month. That means the first 50% of that, or $250, is going to go towards needs. 30% is about $150 is going to go towards wants, and then 20% for savings is going to be about $100.
Yeah, one of the things I really like about the percentages to use for your budget as well, because this is what I started out with, because I started out working in tips where you can't do dollar amounts because you don't know what you're going to earn month to month. Yeah. But another great thing of having those percentages of like 50% for needs, 30% for wants, and 20% for savings is it almost feels like as you continue to grow professionally that you're rewarding yourself for doing so. So that your wants category doesn't stay at the same amount, because you're then growing professionally and your income is growing with that. Then you're able to spend a little bit more. And it just feels a lot more rewarding and less restrictive that way too, I've found. I don't know how you feel about that. But
the needs are the needs. Like, you have to pay for those. But if you find that you don't feel like you're saving enough, or you want to save more, it gives you an opportunity to see the money that I'm spending on things that are just considered wants, like this discretionary income. I mean, we'll call it fun money. Is that money actually going towards things that I truly enjoy spending money on? Or are there things in there where, I saw this at the store, or like when you go to Target and they have those aisles that have all like the $3, $5 stuff. And it's so easy to just buy those things. And you're like, I didn't really need to buy this like ice tray or whatever. So it also gives you an opportunity to understand why money is important to you. And the older you get, the more important it is to know that, so that when you retire one day, you'll know exactly how you want to enjoy all of the hard work that has, all the hard work that you've put into saving for your future.
Yeah, and I will say too, that resonated with me as well, because that 30% wants of just looking back at what you've purchased and being like, why did I do this?
Yeah.
When I very first started budgeting, this is another reason why I think it's so important, is because you'll just spend money on things that you don't even realize that you're buying, or you don't even remember it later on down the line. So it really does help you to bring into perspective, oh, maybe I am kind of bringing things into my life that aren't important, and I can cut those out and it's not going to bother me at all.
Yeah.
But you're not able to realize that unless you do, at least in the very beginning, keep track of it.
No, yeah, I'm sure we could do a whole podcast on
really
things we wish we didn't buy. I wish we could return like today that we can't.
Yeah, that's great. So, and then with one of the last things that we covered just in our introduction to the What I Wish I Knew as a Teenager was debt. And more specifically, bad debt versus good debt. So what would you say is the debt that's okay to take on versus what maybe you should avoid, or if you can't avoid, how to limit bad debt?
So when we talk about debt, we think about loans, or you might think of a mortgage, an auto loan, a credit card. That can be a form of debt if you are not paying the full balance, right? You're carrying that balance. Student loans. So there's many different types of debt, or you can also think of it as borrowing. The main point there is, debt doesn't automatically mean, it shouldn't automatically be thought as a negative. I think at some point, all of us are going to need to borrow money in some way, shape, or form. And that goes into a deeper conversation about building credit so that you can borrow money in the easiest way possible. But just talking about borrowing in general, we think about good debt and bad debt. An example of good debt would be a mortgage, right? I mean, it's a mortgage allows you to purchase a home, obviously, right? Especially, your first home. Many of us are likely going to have to mortgage part of that purchase. So the reason the mortgage is be considered good debt is because it's an investment. Your home is likely going to appreciate in value, right? There's tax benefits to having a mortgage, or they may be, depends on your situation, but there are tax benefits that come with paying your mortgage every month. And when you sell your home in the future, assuming your home continues to go up in value, typically you'll have enough to pay the mortgage off when you sell, and then you'll usually have a little bit left over to either put down on the new house or put towards, another financial goal you have. So that really is just, it's an investment in yourself. It's an investment in your future. And the mortgage is just part of the puzzle to get you there. Another one, you could think of student loans as the same way, because they allow you to, get a higher education, assuming everything goes to plan.
It's a good caveat there.
You work hard, stay in school. You increase your earning potential when you graduate, and in the long term, you're able to pay that loan back plus more. Now let's go to the other side. So we're talking about bad debt. Really, in a nutshell, we're really talking about high interest rate debt, and that is going to be primarily, how I want to break this down, but high interest rate debt is going to be like credit cards. But I want to elaborate on that a little bit more. So credit cards are a great tool to help you build your credit, meaning to help show lenders that you have the ability to pay things back on time. And the more you do that, the more they're likely to lend you more money, and also lend you money at lower interest rates, which means you pay less when you pay it back. Where credit cards can be considered bad debt is if you get into a cycle where you're using that credit card and you're swiping that credit card, but you're not paying the balance off in full when it's due, right? So if you only pay a portion of it, the remainder is going to be subject to interest. And that's where you can get into a cycle of debt, and of really just, it starts to build and it starts to turn into a mountain of debt that you have to pay back. Now, and I can speak from experience with this. My first credit card was like $300 limit, thankfully. But I maxed, there was a point where I had that limit maxed out. I was only making the minimum $10 payment, thinking everything was fine. But then I was getting hit with like a $20, $30 interest rate charge every month. So if you think about it, I'm paying $10 a month. I'm getting hit with an interest charge of like $20. So you could see how long that may take to pay back if you just keep doing the minimum payments. That's just something you have to be mindful of with credit cards. And we can get into the details on that. You might hear that buying a car or taking out a loan to buy a car is bad debt. I think it depends on your situation. I don't think all of us can just go to the dealership and buy a new car straight cash. So I think it completely can make sense to take out a loan to buy a car. The one thing you have to be mindful of is the interest rate that you're getting on that loan. So want to make sure you do your research. And I always recommend, if you're not a good negotiator, bring someone with you that is a good negotiator that can help you get the best deal at the dealership, because it's like one of the most stressful things for me is buying a car. I'm like,
for most people.
Just not good at the whole back and forth thing. And, I just watch a bunch of YouTube videos and hopefully, it works out. But yeah, no, with cars, you just want to make sure that you get the best interest rate possible. Buy a car that is going to last you a long time, right? Like just be careful of shady salesmen and things like that. So that's really all you have to think about when it comes to buying vehicles. And in the future, if it makes sense, if you have the means to pay cash for a vehicle, sometimes that can make more sense.
And I think when you're looking at debt too, with paying off debt, the way that you approach that is just by what is helping me reach my future goals and what's the priority for paying off. So while a car, it may be necessary to go into debt for a car depending on your situation. If you're then later on in the situation where you can afford to pay off some of your debts, then that's going to be one of the higher priority ones, because it's going down in value while you are paying interest on it as well. Mm-hmm. So it's all about, with debt, prioritizing
exactly
those that you have. With that, I honestly just wanted to end off on the question of, with all of these things in consideration with introduction to personal finance, what's one piece of advice or knowledge that had the greatest positive impact on your life so far?
Pay yourself first. Just going back to what my 4th grade teacher told me. Because I feel like I'm doing that now, and I see why she told me that. I see the value of that. It's nice to look at my savings account and be like, oh man, if something happened, if an accident happened, if I need to replace something, I have some money in there to feel safe. And educate yourself. If your school isn't educating you, if your parents aren't educating you, or if you're just curious to learn more, go out there and research, learn what credit cards are, learn how to use them before you have to apply for your first credit card, right? Before that credit card's in your hand, for example. Now for me, one of the websites I love is investopedia.com. I feel like it's just chock full of knowledge and little videos that explain things, right? So you don't have to read a 10-page book for every single lesson. So I would start there. It's just a place to research. And then of course, YouTube. YouTube has a lot of good, typically there's a lot of good sources on there to learn things and to educate yourself.
Yeah, I think the great thing about at least living in today, if you don't know anything about personal finance yet, is that there's a million ways to actually go ahead and learn. You can do books, you can do AI now, you can do whatever way you learn best. The information is out there. You just got to be ready and able to.
Yeah, you can replay this podcast too.
Yeah, there you go.
We're also educating you.
Yeah, but anyways, thank you so much, Christian. And we'll be coming out with some more articles soon about what we wish we knew when we were younger as well. So.
Yes, thanks for tuning in, everybody. And we'll talk to you soon.